I categorize investments in the portfolio into three general buckets. The first is high quality compounders. These are great businesses. We're talking about businesses with great margins, high returns on tangible capital, great market shares, run by great people with good capital allocation. Now, unfortunately, these companies, with great growth prospects, and unfortunately, the market generally overpays for growth, in my view, and these companies are rarely ever cheap enough for me or the fund. So we kind of usually have to wait until something happens. That could be a company-specific problem, or it could be a macro event where everybody's, selling indiscriminately, and we were able to buy these great companies. Take, for example, during COVID, you were able to buy a high quality aircraft engine manufacturer company, or during a European energy crisis, you could buy high quality industrial companies that are just indiscriminately sold because everybody's very, oh no, this is happening. It's really bad. Same thing, tariffs. You can buy companies that are exposed to tariffs. And if you're taking a kind of a 3 to 5 year plus view, like a lot of these things get solved. We're humans. We overcome problems. Like I didn't know when we were going to fly again during COVID, but I thought we were going to. So you're able to buy these great companies when the markets are giving them away at bargain prices. The second bucket is special situations. I love spinoffs. You usually have like a large company conglomerate spins off a small division. All the shareholders of the large company are like, oh, what is this little tiny thing in my portfolio? Index funds, the company's often not in the same index. The index funds are selling, large cap funds are selling. And I like being on the other side of a trade where people are selling for reasons that have nothing to do with the economics of the business. I like being on the other side of that trade. And then also you have the management team is incentivized by this new smaller company. You have the capital allocation. Maybe in the larger conglomerate, they had to fight over, which division's getting capital. And when you run it separately, they're able to allocate capital better. So all the incentives align, and these companies often perform very well. So you get the indiscriminate selling at the beginning, and then you have a much more lean, structured, focused company. And even academic research has shown that a lot of these companies perform exceptionally well afterwards, and taking the 3 to 5 year view. Other things could be these balance sheet restructurings. You could have a company that did some stupid M&A, overpaid for something, got too much debt. Management team gets sacked. New management team comes in. Balance sheet's out of whack, though. They need to raise equity. And if a lot of times these companies have bad stigma. They're like, oh, this is a bad company. That's a bad company because it had too much debt, not because the actual underlying fundamentals were bad. So often these companies are shunned by the market, and again, you can buy them, and good things can happen. So another example would be like a large conglomerate or a family holding company. A new generation comes in, and they start breaking up the company, selling parts of it, trying to realize value. Another special situation that we really like to see. And so, special situations are always fertile hunting grounds for new ideas. And the third bucket is just the deep value ideas. Things that are just so cheap, you just can't resist buying them. That said, we tend to not to buy things just because they're cheap. We like to have, some hidden value. Maybe there's, often we have a company with maybe there's a good division hiding a bad division, or there's, there's an asset, real estate, or something that is backing up the fundamentals of the business as well. Take, for example, we owned a company that had beachfront property in Barbados. And so you had this company that was trading at a great free cash flow yield, run by a great management team. But the market didn't want to pay or give value to the company. And we saw this real estate saying, well, this real estate is worth at least 3 times the value of what the market is ascribing to the entire enterprise value of this company. I mean, it's just ridiculous. So we were able to get a nice dividend. We were able to get the nice free cash flow yield from the company, but underlying it was like, well, we had this property that, they're not making beachfront property in Barbados anymore. So like, this is worth, it's just amazingly cheap, and we have this hidden value there. And what happened? Eventually, a larger hotel company came along and bought them, wanting to realize this value. Um, Other things could be we have a company which has a lot. It was an auto supplier that has an amazing water business, and we think the water business is worth the entire enterprise value of the company. So you kind of get the auto company, which is a cyclical and which we think is probably towards the bottom of the cycle. So you're getting this pretty good company, but you also have the really great company basically backing the entire value of the investment.